Welcome to the Bloomberg Markets Podcast. I'm Paul Sweeney, alongside my co-host, Matt Miller.
Every business day, we bring you interviews from CEOs, market pros, and Bloomberg experts, along with essential market-moving news.
Find the Bloomberg Markets Podcast on Apple Podcasts or wherever you listen to podcasts and at Bloomberg.com/podcast. We're right in smack in the middle of earnings season here. Lots going on, but we do have a big day tomorrow for the market, and then as the Federal Reserve is going to meet, we're going to hear what they're going to do with interest rates. To get a little bit of a preview here, Lydia Boussour joins us. She's a senior economist at EY Parthenon. She joins us live here in our Bloomberg Interactive Broker studio. So, Lydia, what do you guys at EY, what do you think you're going to hear from this Federal Reserve tomorrow when we hear from Fed Chairman Jay Powell?
Sure. So I think at this stage, the 25 basis point rate hike is pretty much baked in. So the focus will really be on the press conference. I think Fed Chair Powell will want to maintain that hawkish tilt and keep the options open in terms of potentially hiking again before the end of the year. So we're likely to see to still have that hawkish tone, and at the same time also sticking to that slower pace of tightening. So in our view, we're likely to see the Federal Reserve skipping another rate hike in September, and by November we think that the economic activity will have slowed significantly, and we will have seen inflation also coming back down quite significantly as well, and that will lead the Fed to stay on the sidelines. And so we think tomorrow is going to be the last rate hike in this cycle.
When it comes to economists and their recession calls, it's really become dicey. If you look at the ECFC function in the Bloomberg terminal, the revisions for the second and third quarter have been adjusted higher. How do you view where the economy is projected to go in the U.S.? Because even just looking at the IMF this morning, they ended up lifting the world outlook just based on the strength that we have seen in the U.S. and the stability there.
Yeah, I mean, we've seen some encouraging signs for the economy when we look at the latest economic data, and from our conversations also with our clients, we are seeing more caution from consumers and businesses, but we're not seeing a private sector retrenchment in terms of activity. So we are seeing a downshift in economic activity. We are seeing that moderation in inflation, and we are also seeing that soft rebalancing in the labor market, and that's definitely led forecasters to raise their expectations for growth this year, and also it has also led us to lower our odds of a recession. Now, I think in this environment, it's still important to remember that there are some strong headwinds currently facing the economy, and that includes tighter credit conditions, and that's going to continue to put downward pressure on the economy in the second half of the year. So we are expecting to see some mild recession conditions later this year.
The U.S. consumer confidence came out, as John Tucker was just reporting, a 2-year high. I thought the Federal Reserve, and I see that data point, I'm like, I can raise rates some more. You think that's a risk?
Yeah, I mean, consumers have showed some resilience. We've seen consumers continuing to spend despite higher interest rates, despite the fact that credit has become harder to access and more expensive. And so that resilience has been tied to excess savings and the fact that they've been able to draw down on these excess savings to continue to spend. And at the same time, it's important also to think about some of the headwinds facing the consumer. We still have high inflation. They can no longer rely on these excess savings to support spending. And when we look at the fall, we're going to have the restart of the student loan repayments, and that's also going to be a headwind for the consumer. So the consumers continue to spend, but they are more cautious. They are also more selective with their spendings.
On Friday, we actually get the employment cost index, which is quarterly. We all know Powell and other policymakers watch that very closely to gauge wage inflation, but also their preferred gauge when it comes to PCE. And then in between this decision and then the one on September 20th, we still have a batch of other CPI data, PPI, as well as PCE. Will that be enough to where, if it continues to ebb, be enough for the Fed to actually conclude this tightening cycle?
Yes, that's the real question. I mean, the Fed has become extremely data dependent, and so they're going to be closely looking at all these incoming data between now and September to make a decision, and that's a key reason why they really want to keep options open to that, to a potential rate hike. When it comes to wage growth, we know that the Fed is going to be closely looking at the ECI. I think there are some good reasons to think that we're going to see some moderation on the wage front. We've seen that rebalancing in the labor market making some progress, and at the same time, we are also seeing the services side of inflation also starting to cool as well. So we're expecting, wage growth to moderate, to show some slight moderation on Friday, and then also looking at the rest of the year.
Lydia, can you explain to me and to our listeners why inflation in Europe is so much more persistent and difficult than it is here in the U.S.?
Yeah, I mean, I think when you look at what's been happening in Europe, part of the story has also been tied to labor markets. So there is some labor market tightness, and that's also what we've seen in the U.S. And then, if you look at the economy, we've also seen some resilience in the European economy. We've seen, the European economy performing quite well over the winter when we were expecting things to get worse. And so part of that, I think, is also helps explain why, inflation pressures have remained persistent in Europe.
Can the U.S. pull off a soft landing because of the dynamics with inflation being very different here than overseas?
If we continue to see some of the dynamics we're seeing right now in the economy, I think there is a chance that we could see a soft landing. I think the runway for the soft landing has become wider as we've seen that moderation in inflation, as we've seen that resilience in economic activity. The economy is slowing, but it's not retrenching. So consumers and businesses still spending and hiring, and the labor market as well. We need to continue to see that rebalancing. I think when you look at the labor market, what's really encouraging as well is that rebound in the labor supply and the fact that labor force participation has also been rising when you look at prime age labor force participation. So if we continue to see that rebalancing between supply and demand, and we continue to see that moderation in inflation, there is a chance that the economy, could, pull off that soft landing.
I think the economists are going to have to rewrite some of these textbooks going forward, because I don't understand and I can't explain really why our labor market is as strong as it is here in the United States. Do you have a theory?
I mean, the tightness we're seeing in the labor market right now is reflecting some of the labor market dislocations that we've seen during the pandemic. We had this dramatic shock that really led to a huge decline in the labor supply, and that came at a time when labor demand became very strong. Mm-hmm. And so that mismatch in the labor market has really generated a lot of labor market tightness, and we saw wage growth, raising very rapidly. Some of these labor shortages have eased, and so that has led to the beginning of a moderation in wage growth. But some of these labor shortages are also going to continue moving forward, and then we also have some demographic factor acting in the background as well, and pulling down on labor force participation.
So if the Fed does indeed raise rates at least 2 more times this year, could that potentially be the policy mistake if we're waiting for those lagged effects after the last 10 meetings where they raised rates, that investors and everybody in the USA was like projecting where this recession could be headed, that everyone was waiting for, that could actually end up potentially tilting the economy into either a recession or just a regime of slower growth?
Yeah, I mean, it's really hard to gauge, and that's the key question. How to calibrate policy just enough to get that soft landing. We do think, given our forecast for inflation to come back down quite significantly, we have headline inflation at 3% by the end of the year. We have core inflation between around 3.5%, 3.7% by the end of the year, and then when we look into 2024, a further moderation in inflation. So we do think that given the outlook, those rate hikes would be unnecessary in this context.
So just lastly, quickly on the core PCE, we're going to get that on Thursday. Consensus is 4%, down from 4.9% the prior period. It's going in the right direction.
Yes, I mean, core PCE inflation is going in the right direction, and core inflation in general. I think if you look at the rest of the year, we're likely to see headline inflation moving sideways as we got past these base effects. And I think the action is really going to happen on the core inflation side, and we're likely to see further disinflation in core services inflation heading into 2024.
Sounds good to me. I don't know. Lydia Boussour, she's the expert. She's a senior economist at EY Parthenon. Kind enough to come into our Bloomberg Interactive Broker Studio. We appreciate that. Thank you so much, Lydia. Looking at these markets just real quickly, Jess, a little bit of green on the screen. I think people are kind of sitting on the sidelines waiting for what we're going to see tomorrow. And
also on Thursday will be the first reading of second quarter GDP that did get revised a bit higher. If you're looking at the Atlanta Fed now, though, they're thinking it's going to come in around 2.4%.
Oh, okay.
Yeah, so that's something we got to keep an eye on Thursday.
So some decent GDP growth, moderating inflation. What's not to like?
You're listening to The Tape, Cantor Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
Let's talk to Dana Peterson because, I don't know, do we have Dana yet? Because I want to get right to that data.
Yeah, she's here.
Yeah, awesome.
Talk about that conference, consumer confidence, that monthly report that obviously came in around a 2-year high there.
Yeah, I want to get right to that because it came in and really surprising, I think, on the upside. Dana Peterson joins us here. She is the chief economist at the Conference Board. Dana, talk to us about this consumer confidence data we got today. Something really got everybody's attention.
Absolutely. It was definitely stronger than what markets expected. And what's important is that we broke out of that range that we had been in for a very long time, seeing the highest reading since 2 years ago. And it was not just present situation, present confidence being elevated, but it was also expectation. So we saw breakouts for both of the underlying indicators here.
One thing I'm curious about, because last week when you were talking to us about the monthly report when it comes to the leading economic indicators still pointing toward a potential recession in the U.S., how do you rectify when you're looking at that data versus when it comes to the sentiment and consumer confidence data?
Sure. Well, the leading index does include expectations. So probably in the next reading, we'll see an improvement in leading indicators, but certainly up through the last measure, it's collecting information on the yield curve, which has been negative for some time. It's also collecting a lot of information on manufacturing. We know there is a manufacturing recession going on right now. So it's gathering up that info. And it's also collecting some of the declines we've seen, or rather worsening we've seen in jobless claims, which, I mean, are still incredibly low, but it does capture monthly movements. And so when you pull all those things together, it's still flashing red for a recession at some point over the next year. So it's not necessarily inconsistent. Consumers are saying that they're not as concerned about recession going forward, but there's still that risk out there that the leading indicators is showing us.
So one of the numbers that really jumped out at me, Dana, was the Conference Board expectations came in at 88.3. That's versus a revised higher 80 for last period. Put into context what an 88.3 means.
Yeah, so anything above 80 means that consumers are not expecting recession. And anything below means they are expecting recession within the next 6 to 12 months. So we've been hanging out below 80 for some time. So it really is significant that we had one reading that was right on the button and then one reading that was notably above.
Where are the pain points when it comes to consumers? Because it looks like when it comes to, say, some red flags bubbling up, especially when you're looking at auto delinquencies, what is that telling us right now? And at what threshold does it need to end up happening and hit to be more of an issue when it comes to a pullback in consumer spending and what that could mean for the trajectory of GDP?
Sure. So I think you have to break it up into goods and services. For goods, consumers have been feeling the pressure from higher interest rates. And certainly if you're starting to see delinquencies go up, that's because interest rates are rising. So anyone who had been financing something, but usually not a car, because that's usually a 5-year fixed rate, but anything that might be increasing in the rate, then that's going to be a weight on consumers, and they're probably going to pull back on durables. And when we look at the 6-month smooth or moving average of the Conference Board's buying indicators, for the most part, they're showing some weakness. But we also asked a special question about services and what consumers are saying. And services don't usually get affected by the interest rate, which is a big challenge for the Fed. But they're saying they're willing to buy fewer things that they want and more things that they need. And so I think that's significant in terms of a shift in what people are actually spending on when it comes to services. They're spending on things that they can't live without and less on the things that they may just desire.
Dana, the consumer confidence number of 117 here, the highest in 2 years. I would think that a strong labor market has to be a big component of that. Just explain to us how labor kind of weaves into that consumer confidence number.
Absolutely. We ask about labor in a number of places. We ask it for the present situation and for the expectations. And in both of those measures, consumers are saying, yes, we think the labor market's doing well. In terms of current conditions, there are more jobs out there than than we even need. So jobs are easy to get. When it comes to expectations, they're saying, yes, we still think we're going to be employed in the future. And certainly when we ask CEOs what they're doing with respect to the labor market, many of them are still saying they're hiring. And then a lot of them are actually just holding on to workers or hoarding workers. They're not looking to let people go. So I think that's also showing up in consumer sentiment or confidence with regard to the labor market. And certainly if you're working and your wages have risen a bit and you're seeing inflation come off and your real wages are rising, you're going to feel better. And I think that's what's being exhibited here in today's report.
Yeah, one of the things that's a new concept to me is hoarding workers. I don't think I've heard of that before. Is that something you economists have seen before?
I'm sure that's happened in the past, but this is definitely something that is very noticeable now. And I think the reason why we're having hoarding is because of labor shortages, and many businesses worked really hard to attract labor, and they're also working really hard to retain labor. And so they don't want to let people go, especially if they think that maybe there might be a recession, but it's not going to be that bad. It's not going to be that long. So if that's the situation, you hold on to your workers, you hold on to your talent, and you don't let them all go and then have to come back 6 to 9 months later and bring them back, rehire them at a higher price point. So that's something that is a phenomenon that, I mean, I can't necessarily say if that's ever happened before. I'm sure it has, but certainly we're seeing it right now. And it's an important development that's affecting the labor market.
Dana, as an economist, how many more rate increases do you think the U.S. economy can handle as we're waiting on those lagged effects?
Well, that's just the thing. It's the Fed has already raised rates by 500 basis points, and nonetheless, consumers are out there spending, and businesses aren't letting people go very much. So the economy can still handle it. So we expect at least 2 more interest rate hikes from the Fed. Definitely this week and then potentially in September, although that September hike may be later if the Fed says that they want more time to sit and wait and see how those lags play out. But certainly for the most part, the economy's been able to manage the increases in interest rates. And it's not clear like how far the Fed can go before the economy itself breaks.
So what do you expect, or what are the good folks at the conference board expect to hear from Fed Chairman Jay Powell tomorrow?
Well, we expect that the chair will say that there have been positive developments. I mean, they're looking at these consumer confidence measures just like we are. We send them to them. And they get it when everybody else does, just to be clear. Yep. And they're looking at that. They're also looking at the fact that CPI inflation has come off. That's not their preferred measure, but they're going to get the BEA data later this week. And I'm sure some of the action that we saw in the CPI will be reflected there. So calmer inflation, lower consumer inflation expectations, a more upbeat consumer. Also, we're seeing that, yes, there is this very weak growth in manufacturing, but services is still doing okay. So with all of that, I would say the Fed would be pleased with the slowing in inflation, but not happy with the ongoing strait that we've seen in the labor market that's challenging keeping inflation or helping inflation to fall further. So right. I think with that, we're probably going to see another hike, certainly this week, and then another one before year end.
We only have about 20 seconds left, but the dissents when it comes to the Fed decision, what are you watching?
Well, certainly there may be some dissents in terms of those who think that the Fed has done enough and we should pause. We've heard that, from a number of participants in the FOMC. So it'll be curious to see if they actually put that down on paper and say, look, we've done enough. We need to sit and wait and see how all these lags work through the economy.
I would be one of those people, just so you know. Dana Peterson, Chief Economist for the Conference Board, joins us here. We appreciate getting her thoughts here. We had some good consumer confidence data coming out from the Conference Board today. 117, the consensus was for 112, so much better than that. And it was the best in 2 years. So how about that? Consumer hanging in there tough.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul, we have this potential UPS strike from workers that might be coming up very soon. So joining us now is Lee Klaskow, who at Bloomberg Intelligence, he's the sector head and senior analyst of freight transportation at BI. He's going to walk us through this. Lee, talk to us about what's happening here. Where do talks stand, and what should we expect to happen from here out?
Yeah, so what we know as of right now is that the two parties are at the negotiating tables. They took a time out because they were really far apart on where part-time wages should be. The Teamsters wanted significant raises, and the UPS put its best offer on the table, and that wasn't good enough for the Teamsters, and so the Teamsters walked away from the table. They've agreed on a lot of other issues. UPS also gave up the recognition of a certain type of driver, to make it just one class of driver. But it's really now the focus is on the part-time aspect. Pay, and we think that cooler heads will prevail. Obviously, as we get closer to that August 1st deadline, the probability of a strike increases. But from our vantage point, the company under the leadership of Carol Tomei truly has at least communicated that they're looking for a win-win-win situation in this negotiation. But I would say the Teamsters, the rhetoric out of their camp is a little more aggressive. There's new leadership there, and I think he wants to prove that he's not like the old leadership, which some people might have thought that kowtowed a little bit too much to the management teams that they were negotiating with.
Lee, I'm probably like a lot of people during the pandemic. Every day the UPS guy showed up. Every day the FedEx woman showed up, with the packages.
Sure.
Talk about essential workers here. Does that factor in at all to kind of negotiations here? Because I kind of feel like I got to throw these guys a little something extra.
Yeah, listen, at the end of the day, during the pandemic, they were essential workers to our everyday lives today. They are somewhat essential. They deliver health care and pharmaceuticals that are important to our everyday life, not just, ordering rubber bands from Amazon, but, they do provide a critical role, not only in the economy, but in our lives. That being said, a UPS part-time driver, on average, according to the company, makes around $20 an hour, and that's not just all they're making. They get health care, and they don't really pay premiums. They get to participate in tuition reimbursement and also retirement plans. So there are a lot of benefits. It's not just the $20 an hour. Currently the floor for a part-time worker is $15.50 an hour. But again, I think the Teamsters are looking to get that to closer to 20. I think that they're going to find some sort of middle ground. I don't really know if there's going to be a true winner or a loser. I think the part-time employees are probably going to be earning more. The union also wants to kind of transfer or create more full-time jobs and less part-time jobs for their members. So I think that's something that they're looking to do as well. And the union is also looking for maybe kind of like a one-time benefit for that work that they've done during the pandemic. That you mentioned, a lot of them were out there working when most of us were home, cowered in our homes.
Do we know how close the two sides are at potentially reaching a deal?
I honestly don't. It really depends on how much either side will bend. I'm guessing UPS will get closer to the $20 mark than what the Teamsters might want. But I think they're gonna, at the end of the day, I don't know, but I think they're gonna find some sort of middle ground. Because at the end of the day, while the union, is threatening a strike, most of the workers don't want to strike. It's disruptive for them. There are some workers that might cross the picket lines, and obviously that's might not be great for morale. They get a very small stipend when they strike, something like $500 to $800 a week, which is not a lot of money, but it's something they get, and they have families to feed. If there is a strike, we believe that it'll be very short in duration. We think anything over a week will be extremely disruptive to supply chains. Obviously, a week strike would still be disruptive to a lot of folks. But it could also be an opportunity for UPS's competitors or even other modes of transportation to pick up more volumes in an area where we're kind of currently in a freight recession, because freight demand has been down for at least a year.
So then what happens if a deal isn't done by August 1st?
It depends. Well, there's a couple things that can happen. The Teamsters can strike, like they said they were going to, or maybe they can have a cooling off period and agree to meet again in a week or two. There's a lot of different things that could happen. But the rhetoric out of the Teamsters is pretty aggressive in terms that they are going to strike if there's not an agreement reached. So if there is not an agreement reached, I'm assuming that's the likely outcome. And politicians, whether it's the Biden administration or other organizations, are hard at work making sure that these two groups find some sort of common ground and the strike doesn't happen. UPS touches, it's been estimated, around 5 to 6% of U.S. GDP. I've seen some estimates out there on the Bloomberg terminal about a strike could add 20 basis points to inflation. So obviously, the Biden administration is very cognizant of that, and they don't want to see the derailment of the economy or a soft landing to become a recession. So I'm assuming that the Biden administration, through back channels, is working very hard to try to get the two sides together.
Leah, I know you also cover the stock of FedEx. So what kind of upside would FedEx perhaps see if there were a strike, or maybe even if there's not a strike? I just want to hedge my bets here and switch my cargo from UPS to FedEx.
Yeah, so we all knew this negotiation with the Teamsters was coming. So this really isn't new news. FedEx kind of went out to the marketplace and said, if you think you're going to need us, you better come to us sooner than later. Last month on their earnings call, their CMO on the call talked about the fact that, while they're not winning a lot of share as of right now, it's opening a lot of doors to have new conversations with customers they might have not talked to. I think net, it's going to be a positive for FedEx. You're not going to see their volumes jump 10%, this quarter because of the strike. Again, assuming that it's not a prolonged strike, because FedEx doesn't have like gobs of excess capacity. They're not just going to take anything that comes. They have to be very choosy about making sure that the freight that they do accept into their network is highly profitable freight for them.
You touched a little bit on what the potential impacts could be, but what sort of like rippling effects when it comes to package deliveries and things like this could end up happening if a deal isn't reached?
Yeah, so so if you're a shipper, either your stuff is just going to get delayed, and you're just going to okay, I'm going to wait through this. UPS has said, at least there were press reports that they've said that they can handle 4 million packages a day. They do around 20. So and we're talking about their domestic business. So we're talking about 20% of their overall volumes. You're also going to have people that might be crossing the picket line. So call that 5 million. So there's 15 million packages a day that are either going to be delayed or lost. There's estimates out there that about a third of that 15 million might be lost for good, meaning that it might need to find different routes. That can go through the U.S. Postal Service, it can go through FedEx, it can go through, there's a lot of regional parcel carriers, and it also could benefit truckload and less than truckload carriers, because they might be shipping things closer to distribution areas and then handing it off to whether the post office or local final mile delivery companies. So a disruption would be a benefit to a lot of transportation companies that we cover, whether it's the LTL space like an XPO or an Old Dominion, or a truckload space like the Knight Swifts of the world. And even the brokers, because if you're a shipper and you're getting desperate to get your freight from point A to point B, you're going to find all your try to find all your channels. So a C.H. Robinson or RXO might benefit from that. And again, we're not talking about there's all going to be a huge jump in volume gains. It should be an incremental positive.
All right, Lee. Great stuff, as always. Lee Klaskow, Senior Transportation Analyst for Bloomberg Intelligence.
You're listening to The Tape, Cantor Live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or listen on demand wherever you get your podcasts.
I want to move over to our next guest, who's in studio with Paul and myself, Scott Caraher, who's head of senior loans at Nuveen, who's joining us to discuss the loan activity in the U.S. and the credit quality among businesses as well as banks. Talk to us about how big the loan asset class is, because I think it's something around $1.5 trillion when it comes to assets. And it's actually larger than high yield and private credit. And I don't think a lot of people actually know what's happening in that space right now.
That's correct. It's interesting that this is a market that has really grown over the last 10 years. And if you think about what the loan market, the broadly syndicated loan market really is, it's where U.S. companies that are not investment grade go to get financing. And one of the things that investors don't really understand about this market is if you're investing in this market, you're really buying a broad swath of the U.S. economy, right? If you think about a lot of the loans that are in our portfolios are things you and I touch every day. Things like Uber, Burger King, Caesars Entertainment,
Right.
ADT. If you put in contacts everywhere, in Bosch and Loam, and so these are loans that are in many cases public companies, large leading market shares. And the other thing that I don't think people really understand about the loan market is there are two very unique qualities that don't exist in other parts of fixed income, and that is they have no duration, right? And so as the Fed has been raising rates, it has had no impact on the price of loans, because as the Fed raises rates, the overall yield or coupon on loans steps up. And the other unique aspect of the loan market is that these loans that we're making to these companies are first in line to be repaid. And so if something goes wrong, we get paid back first, just like the mortgage on your house. If you choose not to pay back the mortgage and the bank comes to get your house, well, they are going to pay themselves off first to protect themselves. And so those very unique factors in the market have really allowed for very good volatility in return streams over long periods of time.
So, Jess, I was fortunate enough to receive some of the best credit training on Wall Street, and that was the Chase Manhattan Bank
There you
credit
go.
training program back in the day at One Chase Manhattan Plaza. So I can handle my own there, and I'll lend you up to 6 times cash flow. How about that? You're a good
great.
customer. Scott, what sectors do you guys like right now in the senior loan market?
Sure. So what we've really been focused on over the last 2 years is, one, going back 24 months when inflation was a big problem, right? And really trying to avoid sectors and subsectors that were going to hit the profitability of certain companies and industries, i.e. Industrials, food, things like that, where companies were going to get squeezed. And now on the flip side, as we've seen inflation really start to abate and come down, and a number of those companies, the price of those loans traded down because of the rise in inflation and the hit to earnings, really focusing on companies and industries where inflation has flipped from a headwind to a tailwind. So think about things like industrial, food, manufacturing, companies like that, where we're really seeing a nice uplift to earnings. But not only that, in many cases, we've been able to buy loans at a discount because, again, our market trades. That's the other thing I don't think people understand. Our market trades every single day. We have transparency on the price of our loan. So we can go, and if a company misses numbers, if there are operational issues and a loan trades down 5, 10, 15 points, we can go in and buy and sell those loans every single day. And so what we were doing going back 8 to 12 months, as we saw the inflection, as we anticipated numbers starting to get better, able to buy loans in the high 80s, low 90s with very nice yields in the double digits. And as inflation has come down and earnings has inflected, we've really been able to find some opportunities that have traded up very nicely.
So then why don't retail investors have exposure to that space? Is it just something that's maybe not as sexy of an maybe asset class as when you're thinking about some of these high flyers in the stock market?
Yes, it's a great question, and candidly, it's a little bit of a head scratcher as to why. I think one of the reasons is regular investors cannot go buy an individual loan. They have to buy a mutual fund or an ETF. And so what I think has happened is in the institutional space, what we've seen over the last 10 years is institutional pension funds, endowments, they've doubled their exposure to the loan market. It's gone from just over $200 billion to over $400 billion. Retail investors, on the other hand, their exposure to the loan market has essentially flatlined. And so retail investors only own about 6% of the loan market. And in my opinion, and maybe I'm a little bit biased, but if you think about what it offers, floating rate, zero correlation to the Barclays Ag, very low volatility. Yes. Yes. And so there's zero correlation to that ag, right? And it's outperformed that index by over 20% over the last 2 years. But all of the return and volatility characteristics are something that we think is incredibly important for retail investors to understand and appreciate and add to their portfolios, just like institutional investors have recognized and allocated to over the last 10 years.
Scott, got about 30 seconds left. Private credit has been a big market. We've seen so much money flow to the private credit business. How does that impact your business?
It has not impacted it really to any large degree. Private credit has certainly...
Do they syndicate their loans out to you guys?
No.
Generally, no. They hold them.
So private credit will put those loans on their balance sheets and hold those until maturity. There's also those loans don't trade.
Yep.
And so the public market and the private market are really learning to coexist. There's a lot of important and attractive characteristics of the private market, just like there are in the public markets, and they're very much complementary. So what you're going to see going forward is the public market and the private market really coexisting and offering unique characteristics that we think investors will recognize and allocate both to private and to public credit.
Great stuff, Scott. Thanks very much for coming in here. Really appreciate it. Scott Caraher, head of senior loans at Nuveen, an asset class that we don't talk about enough, but it's a business near and dear to my heart. Love the old credit analyst. Credit's hard and equity's soft. I heard that a number of times. This is Bloomberg.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Very difficult to be a media investor these days. I follow this sector for more than 30 years. Today's is as tough as it's ever been. You've got this whole business model evolution, or switching from the core cable TV model now to the streaming model. You don't know where those economics are going. And now you've got a couple of strikes in the industry, one with the writers, another with the actors. And we want to get kind of the latest on what's going on there and what's really some of the fundamental issues here. And we're joined by Takeuchi Cullen, Vice President of Film, TV, and Streaming for the Writers Guild of America East. So I'm guessing that's kind of a New York thing. Lisa, thanks so much for joining us. From the writer's perspective, can you kind of just frame out for us what your issues are with the industry, or what the issues are with the media companies?
Sure. Our main issue is compensation, as is the issue for, I think, a lot of workers across America today. Our compensation has been eroding in a time of what people consider peak entertainment, peak television, peak film. There are record numbers of people going to see these things and watching them on streaming at home, and record profits, record revenues, while meanwhile the people who create the content have been making less and less. TV writers in particular are making, adjusted for inflation, about 25% less than they were 10 years ago. And this is a time when television has been exploding as a medium and as companies have been raking in the revenues and profits. So all we're asking for, really, just like the actors, just like the crew, just like the Teamsters, is our fair share of the product that we create.
And what specifically are you, when it comes to the writers, are they looking for to get back to work? What are the demands right now?
The demands are that the studios meet our proposals and actually engage in negotiation on them. Our proposals remain exactly what they were when we began the strike on May 1st. And can
you summarize kind of what they are, the main proposals?
Sure. The main one is a raise in our minimum rates. The contract that we work under is called the Minimum Basic Agreement, and essentially it outlines what the minimum rates can be for film and TV writing in our industry. And we are trying to negotiate a hike in those rates because, adjusting again for the spike in inflation, writers are making far less than they were, to a point that it is simply not sustainable. We have members who cannot make the rent, who are on actual food stamps. People don't think of that when they think of Hollywood. They think that life is glamorous and that we're all rich and we own yachts and private jets. And most of our working people are middle class, if that. Now most of them are struggling to maintain a toehold in the middle class. So it is raising our minimum rates. It is adjusting residuals for this age of streaming. That is a huge issue for both the writers and the actors. We are not seeing anywhere close to the residuals that kept us afloat for decades, back in the days when the model was not broken. But all of the studios jumped on the streaming bandwagon, and now here we are with this broken system where none of us are being compensated in a way that allows us to live. We're also fighting for some sustainability in our careers in both film and television. We have seen our ability to manage our work and to create with our own creative license erode. TV writers are no longer allowed on sets if they're working on streaming shows because of the long delay in between a writer's room and when the actual production occurs. We're fighting for growth in the size of a writer's room, which is the room that convenes before a television show is made in order for writers to come up with a plot and to write all of the episodes. The rooms are becoming smaller and smaller as the streaming budgets for writing shrink. And I say for writing because streaming budgets for shows and movies have exploded. Studios are spending $19 billion a year on actually making these shows and movies, but the slice of the pie that writers are getting is getting smaller and smaller. So we're fighting for all of those things.
Lisa, I've covered the media industry as a financial analyst for more than 30 years, and I've never seen an industry that has so much uncertainty in the core business model. If I were an executive at a media company, my response might be, our model is broken, and we don't know what the profitability of streaming is. We don't know how people are going to consume media going forward. We're trying to adapt from what you mentioned correctly before, which is, the traditional model that we all grew up with, whether it was supported by cable subscriptions and 100 million households paying money every month. That model's pretty much gone away. Now we're trying to replace it with the streaming model, but the economics are uncertain. Is that an argument that resonates with you guys at all?
No, that's not our problem, right? I'm not the CEO of the company. I'm not the one who chose to enter into a major merger with another company or takeover of another company that placed my company into a great amount of debt. So now I'm not able to pay my bills. The companies are still making profits hand over fist. They are still raking in what is it now? I think $30 billion in profits from entertainment alone. And I'm not talking about Amazon's packaging business or Apple's computer business, from the studio companies, from the profits that they make just off of the product that we create. They're making $30 billion in profits a year. So they're the ones who have to lie in the bed that they made, but it doesn't excuse them from having to pay their labor fairly, right?
How has the rise of streaming affected writers' compensation?
It has decimated writers' compensation. streaming has changed the way that we work. It used to be that under the network broadcast model, that writers could be employed 40, 45, 50 weeks a year because the television shows would run for 20 episodes, 22 episodes, 23. And the rooms would convene in the early summer, and they would run through the spring, and then there would be a short break in between. Not only would we make the weekly pay that would sustain a middle class lifestyle, we also would make residuals, meaning that when those shows were rebroadcast in foreign markets or on cable television, we would receive checks in the off times that perhaps we were not working on a show or perhaps we were on a hiatus that would pay our bills and continue to sustain a decent lifestyle. All of that has gone away. Streaming has introduced the idea of what's called a mini room, which is a studio concept that is mini in every way, mini in size, mini in duration, mini in pay. And that means you gather together a very small number of writers and you pay them at the minimum rate allowed in our contract to produce 10 episodes. And I say produce, meaning write. They're not actually producing it because, again, the production occurs much later. But they're writing, say, 10 episodes of television in 10 weeks. And then they're sent off to try to fend for themselves for the rest of the year. And that is simply not sustainable.
Lisa, how far apart, based upon your understanding, how far apart is the union and the industry? And second, how long is the union prepared to stay out?
Sure. So as an officer of the Guild, I have been involved in the negotiations from the start. And I will say that the studios simply refuse to even engage with us on our core issues. So I would say we're still far apart until they come back to us and say, okay, we hear you on your core issues. This is our counter offer, and then we can come back with another counter offer. That's what a negotiation is, and they have refused to even negotiate on those points. So we do need to get there. As far as how long we are willing to stay out, I talk to membership every single day, as do the other officers and the other members of the negotiating committee and the other elected officials. And our unity is strong. Our solidarity is strong. Now that we have had 160,000 reinforcements when SAG-Aftra joined us on the line, the feeling is that we have to get what we came for. We have to get what we came for, or else it is absolutely an existential crisis for us. The career of writing for Hollywood will no longer exist. So I believe that we are willing to do what it takes.
All right, Lisa, thank you very much for taking the time. Really appreciate it. I know it's a contentious issue on both sides, and hopefully both sides can come to an agreement sooner rather than later. A lot of jobs at stake, and a lot of folks are depending upon it.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Jess, here's our next guest. Here's a who's who of some of the top names on Wall Street. Salomon Brothers, Oppenheimer, Goldman Sachs, Government of Singapore, as we kids call them,
one after
GIC,
the other.
Lehman Brothers, and now for the last, 13, 14 years, Bloomberg Intelligence.
That's quite the CV.
Top machinery analyst on Wall Street, bar none. And Karen Ubelhart, she's here in our Bloomberg Interactive Broker studio. She's been covering machinery and all that kind of industrial stuff that we make for a long time.
Telltale signs of the economy.
Exactly right. Karen, thanks for joining us here. Let's talk about a company that we don't talk about enough, but it's one of Tom Keene's favorites, Minnesota Mining and Manufacturing, 3M. They had some good numbers today.
They have a big consumer exposure, so their organic growth was actually down, but down less than expected, and they delivered on the margin side. They've done a huge restructuring. It seems to be gaining some traction, and also expectations are so low for 3M now since they've had a lot of problems, particularly the litigation problems. So,
but boy, they're in everything: safety and industrial, transportation, electronics, healthcare, consumer. This is a conglomerate, right?
Yep.
Yeah.
They make everything from the Post-its to grinding wheels. So they literally are GDP.
I mean, looking at that stock, ticker symbol MMM, up about 5%, so on pace for its best day since the beginning of June. You look at its stock, though, year to date, down close to 9%. What's the story there?
They have a tens of billions of dollars litigation problem for environmental. It's PFAS is the name of the chemical that has been hurting water. And so that could be $25 billion. They've got another one on earplugs for the military. So they've got a lingering 30 billion, 40 billion plus litigation that potentially they would have to pay over a long period of time. That's the biggest problem. And then they've also disappointed on performance, on operating. But we've had 2 quarters now where they beat on revenue and they beat a lot on earnings. So I think the reason it's up is people are saying, oh, is it coming together on the operating side?
St. Paul, Minnesota, the home. Great town. I love St. Paul.
Yeah.
All right, great hotel. I can't remember the name of it, but that's where you always stay when you go to marketing in St. Paul. All right, let's go to GE. What is GE today? Tell us what they own, because all I remember, it's been an investment banker's dream just selling off businesses left and right. So I'm not sure what's left. And then what do you expect from their earnings?
When I started covering, they were in 8 businesses. They're now in 3, and they're about to be in 1.
Really? Wow.
What's left is aerospace. That will be a standalone company. And then and what they're calling an energy company, and it's basically renewables and their big power business, the turbines, the big turbines. That's what's left. Those are going to go together, and aerospace is going to stand alone. That's what's left.
Really? So the GE will just be
a pure play.
Okay.
Aerospace.
All right. So talk to us about kind of what's left and how's it performing, and they're going to be reporting earnings. What are we looking for?
They actually did report this morning, and they beat by a lot. That's why the stock's up. And aerospace is through the roof. And people, you estimate 20% growth. It was up 28%. It's just exploding on both the OE side and also on the commercial aftermarket side.
Yeah, looking at that stock, up 6% this morning, and then year to date up 80%, trading around multi-year highs.
You've been waiting a decade plus for that.
A while for that. But the other thing is their other side, the Vernova piece, has really struggled largely because of the renewable business. And that came together nicely, today as well, with huge orders, like a tripling of orders. And the losses were much less than expected because the volumes were up so much. The volumes were up 27%, and the street was looking for 5%. So that business is the one that's been, hanging around their neck. That can they fix it? Can it be a good business? I'm not sure it can be a good business, but it's a lot better business than we thought, and that's what's really going on.
So talk to us about this turnaround for GE after it was kicked out of the Dow in 2018.
They particularly in their power business it just fell out of bed, and they had way too much capacity for the large turbines, that generate electricity. We don't use them anymore. The stuff that's there will still be, the installed base is still good, but the growth rate of that market and the size of that market has been cut in half. Then you've got a wind business that they've lost money in for a long period of time. So you had a lot of lingering problems, and the finance sub was a real problem for them, and they basically got out of the credit sub, and there are a lot of write-offs related to that. So it felt like they couldn't get out of their own way for a couple of years, actually.
There's nobody better to ask this question, which is, because you've known this company forever, what do you think today, with hindsight, the legacy of Jack Welch is?
I have said, and I said this a while back, that someday they're going to, they wrote the book, The House That Jack Built. Yep. Someday they're going to write the book, The Straw House That Jack Built. And I hope I don't get in trouble for that.
Because, there was a time when he was building up General Electric mainly through acquisitions, presumably, kind of like that conglomerate model, trying to find businesses with great returns and all that kind of stuff, and just building them up. And then GE owned everything from NBC Universal to turbine engines. And
light bulbs.
Light bulbs, exactly. And that was... The conglomerates, that was a real business strategy for decades in this country. Jack Welch, arguably the most prominent proponent of that. Now that's, I think probably the market has been saying for the last 10, 15 years plus, that's not where we want to be.
Well, he grew the finance up to be 50% of GE's earnings. It was very profitable, and they got involved in a lot of financial things that they probably should not have been involved in.
But originally it was set up, you want to buy $100 million piece of equipment for me, I'll help finance it, just like an auto
and that's what it's back to.
Yeah.
That's what it's very small. They finance like the big turbine equipment, et cetera, but they are out of all that other stuff. But they had to take huge write-offs to get out of that.
The financial crisis.
Yeah.
Right.
And the other thing is he was, in my opinion, in order to get higher margins every single quarter, he, I think they milked the R&D and they had to play catch up on that as well. And I think that was another problem. So he really was, the king of industrials for a while, but Immelt was left with a rather large headache.
When you're looking at these earnings results from 3M to GE, what do you think these corporate profits in this particular segment of the S&P 500 tell us about the direction of the economy?
I don't think the economy is as bad as people are anticipating. People are worried about a fallout in the second half. Some markets are slowing, but it's a pretty narrow slowdown. It's certain consumer markets, and more that actually is probably spreading. But the industrial side is really solid. And if you see all the mega projects from onshoring, the infrastructure bill, the IRA, which is why wind is doing so well, all this federal money is just going to prop up industrials. And I don't really see we're going to see an industrial recession.
How about China? I mean, your companies deal with China like nobody's business. So what are they saying?
It's slow. The recovery is slower than expected. 3M actually has a large exposure to China, and they said they're in recovery now, and it was down 8%.
Are they worried? I mean, how are they framing the geopolitical risk around the U.S. and China, or China and the West?
People are, I would say that you're not going to see more dollars spent there because there is some concern about that. It's an important market. It's 5 to 8% of sales for a lot of these companies. They can't pick up and leave. But they are certainly rethinking at least how the business is sized, because we don't know what's going to happen politically, and the recovery just is really taking a while to get going.
So how do they? Just 30 seconds. What's kind of the top area that you're looking? What's the hot?
The two hottest areas. Aerospace is just on fire,
right?
And that has a lot of legs. Also, anything climate related, like the HVAC business. Residential HVAC is down, but the rest of the business is strong, and we've got $1 trillion in money, tax credits. It's $300 million in tax credits and $1 trillion when you gross it up of money as a result of the IRA.
Yep. All right, Karen, great stuff. Always appreciate getting your insight. Karen and her companies touch everything in this U.S. economy. It's amazing. Some of these companies.
And looking at this industrial sector in the S&P 500 trading around records.
Yeah. Yep, good. Yeah, a lot of stuff. Everybody wants to talk to Karen Ubelhart now. Karen Ubelhart, senior analyst, she covers the machinery and all that industrial stuff for Bloomberg Intelligence. Appreciate getting a few minutes.
You're listening to The Tape. Catch our live program, Bloomberg Markets, weekdays at 10 a.m. Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Paul, we've talked so much about particular industry groups that have really rebounded as things continue to reopen from the pandemic. And one of those, especially when you're looking at what's happening with some of these gym-related stocks, looking at what's happening with Lifetime Group, that's ticker symbol LTH, up close to actually more than 50% this year alone. And who better to join us for our C-suite conversation than Bahram Akradi, CEO at Lifetime Fitness, who's joining us on Zoom to discuss his company post the pandemic, as well as earnings and the outlook when it comes to consumers as well as gym goers. And you've talked a lot, Bahram, about how when it comes to Lifetime Fitness, this isn't just a gym. It's supposed to be this sort of country club experience. Talk to us about what's been the key to your success, especially when it comes to the reopening that you've had over the past year.
Fantastic. What we focused on from the time we reopened, it was desirability for our customer. We worked on programming. We worked on much more elevated experiences across all aspects of what we offer, whether it's the beach clubs, our food, our spas, our personal training, small group training, our RUP program, all of the different programs. We added pickleball at the sort of an incredible pace. We're up almost to 600 courts today. We will have at least 700 by end of the year and 1,000 by end of next year. So we basically have listened to see what the customer wants and offer that at the most experiential level. Everything's working beautifully. We are completely happy with our results. We're right where we expect to be. We are doing this without any promotions, any salespeople. We're just focused on creating that desirability, and the customer is pouring in. Our results have been never better. We have the best margins. We rewired the company structurally the last year to make sure the decisions are made much more rapidly to satisfy the customer, and that has also generated massive improvement to our margins. So it's all good news.
Bahram, your stock is down 15% today on your earnings. Your sales disappoints. Talk to us about what happened with the latest quarter and kind of what your guidance is here.
That's honestly enigma. We didn't miss anything. The analysts have missed completely. They have tried to listen to our sort of tone about EBITDA, and they tried to get to that EBITDA by lower margins and just pushing the revenue numbers up. Our revenue is exactly where expected to be. It's within the range we gave the street. So I have no apologies for anyone. Our team is working their cans off. Everybody's performing. We're super happy with the momentum of the business and where we can take it from here.
Well, it sounds like at the very least you need somebody to manage streets' expectations so you don't have that volatility in the stock. That would just be an aside from a former analyst. Talk to us about what are your growth drivers going forward here as you adjust to kind of a new world where people are getting back out again.
Yeah, actually the clubs are doing fantastic. Many clubs are at the point where we really are putting them on wait list, and then we just basically meter the people in so that we can manage that experience. We have ability to basically create the rack rate where that we can create optimal experiential for the people. We continue to create, invent programming. The most recent one that we are in the guts of getting it rolled out by beginning of fourth quarter is dynamic stretch. We'll have that rolled out to about 150 locations by October 1. So we continually think, invent, reinvent opportunities to serve the customer in all aspects of their healthy living and healthy aging. And so we have many, many other initiatives in the works. So I anticipate double-digit growth for this company, top line, bottom line, for the foreseeable future.
Let's talk about the demographics, because the average membership is over $200 in some key areas per month, and more than 40% of the members are under 35 years old. So I'm curious, when it comes to student loan repayments, how that could potentially impact your business.
Yeah, you know what, honestly, I don't see that being a factor whatsoever. Our memberships are very broad, from very, very young people to very, very old people. We have kids from 90 days old in these clubs with their families, all the way to 80, 90-year-old members. So there, no one segment is going to have an impact in our business in a way that people think, oh my God, the student loan is going to make. We're not seeing anything. In fact, the number one indication to the health of our membership is attrition rates, which, as I mentioned earlier, June was the first month we saw after COVID, that after reopening, that we had attrition rates below 2019 rates. Now that has followed through with July and August having exactly the same trends. And we take attritions today for September, so we already know the numbers for July and August attritions. So it's all showing complete signs of strength. We're not seeing any weakness in our clubs or our performance. So, and again, the students, those who can be impacted by this, is going to be a small section. Lifetime is so broad in terms of our offering, in terms of our demographic, that I don't think any one sector is going to make a difference with us not being able to deliver the numbers we guide the street.
All right, Bahram, thanks so much for joining us. Bahram Akradi, CEO of Lifetime Group Holdings. That is a New York Stock Exchange listed stock. They went public last year, or I'm sorry, 2021 at $18 a share. The symbol's LTH. That's a ticker load into your Bloomberg terminal.
Thanks for listening to the Bloomberg Markets Podcast. You can subscribe and listen to interviews at Apple Podcasts or whatever podcast platform you prefer. I'm Matt Miller. I'm on Twitter at MattMiller1973.
And I'm Paul Sweeney. I'm on Twitter at PT Sweeney. Before the podcast, you can always catch us worldwide at Bloomberg Radio.